Clearly, volatility was the main topic of most of the queries. What's happening? And that is the thing we will examine. This is going to be recorded on the 29th, so later on Wednesday we have FOMC. After this, we will discuss what is really significant volatility, which followed our prior episode on the 15th. Gold and silver were able to be targeted for an officially targeted speculative long stock rinse, specifically going after the naked longs from the COMEX, so expect the usual kind of stuff to happen. In addition, we're going to connect all the short-term action with the interconnected reasons. In the process of shaking out the speculators, whom we have always said are the problem, this move essentially took out most of the October move higher. However, after shaking them down, what it has done is transferred wealth from weak hands into strong ones at a higher physically supported rally point, specifically gold and silver. Now, very strong physically held hands are taking up this naked short sell of gold and silver, and they haven't gone away, even though the 10% top-to-bottom correction has gotten rid of all the froth and has now caught the same leveraged actors off guard, leading them to switch from being naked long and chasing it up to naked short and chasing it down. Additionally, it was noted, and we will make all the necessary connections, that Trump's China posture was timed to coincide with the trigger point to hit these inflated speculative holdings. All of this is now linked to new weaponized geopolitical energy sanctions, the main purpose of which is to exert pressure on the BRICS fulcrum, specifically the core countries of Russia, India, and China. The gold-rich BRICS group was another target of Trump's attempts at retaliation. It is now clear that billions of dollars worth of COMEX gold and silver were produced and sold into the market to prevent the gold price from rising beyond 4,400, in tandem with the weaponization of energy geopolitical sanctions. The Fed was forced to repurchase 4,400 tons of gold at the end of the month from the Bank of International Settlements, a $600 increase from previous month's 4 tons, which were sold for $409 apiece at a loss. As a result of its disastrous management of the U.S. Treasury's gold holdings, the Federal Reserve is currently the sole central bank involved in the ongoing gold price roller coaster. Furthermore, there are still 30 tons that need to be purchased, in addition to the publicly visible billions of dollars in wagers made by the Office of the Comptroller, the OCC. These bets are directly tied to the rehypothecations and multiple ownerships involving the U.S. Treasury. What it may be doing, in reality, is potentially defaulting into this enormous physically supported rally. One obvious omission is the actual purchasers. The U.S. Treasury's gold holdings mean that 30 tons must be repurchased, on top of the billions of dollars in OCC bets already associated with these rehypothecations. That is a serious problem. To temporarily halt the massive de-dollarization flows visible in the gold-dollar foreign exchange cross, that is, selling dollars to buy gold in FX crosses, the U.S. Treasury stepped in. Any other trader would have been margin called by their broker and forced to cash settle such enormous unhedged losses. This is why we know it's official. Keep in mind that it is money. So, they could simply assess the magnitude of such resistance, yet as it would be short-lived and focused, they would be aware of its limitations. There is a hard cap on the number of COMEX speculators that could be eliminated before physical support equilibrium is achieved. This resulted in a 10% adjustment. In a moment, we will examine that in the charts. Simply put, this is nutritious food. But as we'll see in a moment, this limiting is dependent on the liquidity of the dwindling COMEX derivatives market, or the amount of leverage that can be created in the COMEX, and how much of that can be removed before the house is exposed to delivery obligations that they can't meet. Now, this liquidity ran against a wall of bias as it tried to push back against the rush of physical market liquidity from central banks, sovereigns, and institutions. Sovereign purchasers and central banks are demanding physical assets, while unleveraged entities are speculating about paper, and gold. We will examine the future of this situation soon. Additional information will follow. Before we get into the long-term answers, we need to examine the immediate aftermath of our last episode on October 15th. This will help us address the many short-term issues that we had. This 3-week top-to-bottom pushback against an out-of-control spec-assisted China-orchestrated BRICS plus dollar-to-gold de-dollarization escalation appears to have reached its exhaustion stage, so let's take stock of where things stand. That was the situation. The speculators were a driving force behind that. That was their aim. Alright, let's take a brief look at the charts. The last time we were here was actually 2 weeks ago, so let's go back in time a little. The smaller chart is exactly where I intend to focus my attention. The current COMEX-driven volatility can be better understood if we first place ourselves in context, which is what we will do. This is the second of two margin increases that the speculator-driven run to all-time highs has experienced. Now, as you recall, we had deliberated over this peculiar circumstance for quite some time prior to its actual occurrence. We had anticipated margin gains and were perplexed as to why they hadn't materialized. This is important to remember because there have been no margin increases since November of 2024. We brought notice to the first one when it arrived on October 9th. Just 2 weeks ago, we were here recording. We brought it to their notice by essentially asking why the House had delayed raising margin borrowing fees by 11 months and a $1,550 increase in the price of gold from $2,500 to around $4,050 was when they decided to raise them. The futures charts look like this. Additionally, we cite this example to show that a 7% increase was essentially made. Borrowing COMEX gold at 95.75% leverage, down from 96% previously, is still an option. So there's hardly any change. Put simply, that amount might be used to borrow gold chips from a casino. The second one subsequently came into view. Why was that even considered? This was not an accident. That arrived simultaneously with gold's meteoric rise to new all-time highs. We go into the reasons why the LBMA-CME cartel, the House, was wrong-footed naked short gold. A margin increase at that time would have forced them to buy back shorts into a bid-only setup, which is why borrowing costs were delayed until they reached around $4,050. They were waiting for a sufficient number of speculators to join before they could rinse out. Since the BIS had squared its final 4 tons here, you can probably guess what was going on up above. It should be noted that this was $409 more than the September forced closing, so basically August is over. Apologies. As a result, we ended September $409 higher. Something had to be done to prevent a full-blown derivative gold default, as there were 30 tons left to cover in what was actually a $600 per ounce surge. Specifically, not to impede a possible increase in the price of gold, but only up to the point where a certain number of speculators could be enticed to go long while the House is short by 1-to-1. The sweet spot was reached on Monday the 20th. At this point, the attention had been drawn in to an extreme before it could even begin to expand. Once more, the home side comes out on the losing end. Currently, preparations are underway for a bid withdrawn event and 2 margin hikes. Along with that, and keeping in mind that these market makers are present in both the COMEX and London, it was revealed shortly after. This is the COMEX market, also known as the derivatives market. The specs had sucked in naked long, bid pulling was involved, and they ultimately decided to pull the plug on these large leverage positions. So where exactly did we end up? An end to the void. The margin rise brought the expense of borrowing $3,000 more per contract, bringing the total cost to $20,000 to run that contract. Yeah, like I said, it was plenty. These investors are taking advantage of the profits they made in the past to further leverage their positions. Thus, this was a traditional washout. This margin increase, along with strategically timed bid pulling by pit managers, was designed to trigger a self-fulfilling waterfall spec long stop ignition, since enough speculators had leveraged themselves long using paper profits to add more borrowed gold to the limit. Thus, the following complete retracement of the 3-week surge, this point here, around the 5th, is the culmination of a 3-week rise. A full gap close flush with the speculators from the beginning of the October rally, all getting rinsed out. That's how it can be put simply. Additionally, momentum is incorrect at the beginning and finish of a move, as it always is. Beyond that, they are inherently opposed to any kind of sideways movement. They swiftly switched sides and bet naked short after being forced into a pillar-to-post rinsing. Basically, the specs and longs were completely washed around this level. After that, you'll have a couple more arrive. Afterwards, these sales were completely exposed. Whereas before inflating naked longs drove prices higher, today we're seeing the contrary happen and the boundaries are being reached by ballooning naked shorts. Here we have a traditional bullish situation. For your information, I will be taping this on Wednesday. This is Wednesday the 29th, right in the middle of the 2 fixes, the morning and the afternoon. So naturally, FOMC is not going to be happening anytime soon. In the near future, there will be some reciprocal activity. We believe that taking out the short stops to the upside is now more advantageous than trying to make a short sell of gold lower. The same holds true with silver. However, we will examine it shortly. The House is covertly taking the long side of these borrowed short bets, and momentums will be the last to know. As we will see, these speculators are now in the sights of the market, and they stand to lose a lot of money if their bids cause prices to overshoot physical support levels where real money is held. It's the exact opposite of them growing longer. Now, as expected, the directional momentum specs, who control a significant portion of the COMEX open interest in gold, silver, and oil, have acquired gold from the short side. It appears as though this has been unfolding into what appears to be the latter stages of a surrender rinse. The house must now be on the side of these speculators due to its growing exposure to upside T+1 delivery demand and forced delivery commitments that are actually being loaded out. Adding more paper shorts would force delivery, and they don't have the cash on hand. As we get farther into this two-way spec flush, it will become clear that institutional and sovereign buyers from central banks are secretly buying up a rising dollar. The dollar's ascent has accounted for most of this. In your opinion, what are they up to? Sure, they'll tell the automated spec sellers to sell gold and silver when the currency rises, but they're saying, okay, hey, we've got a rising dollar is the actual money's message. Oh my, here's a chance to turn dollars into gold and silver. This means the correlation is occasionally becoming very weaker. Therefore, this prepares the market for a competitive short-stop rinse to the upside, which will lead to a rebound from the next higher physically established speculator-free price. Then the next wave of hot money will prepare for a new round of long-stop